Okay, quick disclaimer before we get started. The Blockmates podcast is for entertainment and informational purposes only and does not constitute financial advice. The information and opinions expressed on the podcast are those of the host and guests and do not necessarily reflect the views of Blockmates or its affiliates. Listeners are encouraged to do their own research and consult with a financial advisor before making any investment decisions. Blockmates and its affiliates are not liable for any losses or damages incurred as a result of the reliance on the information or opinions expressed on this podcast.
Hi everyone, good local time. Gareth from Bumper, one of the co-founders. Welcome, sir. It's great to have you. Taking
thanks.
Risk management to a whole new level. A bit of an intro to what Bumper are doing. Essentially, they are saying that if there's risk, they can mitigate it through their protocol, and we're going to find out how that works. Gareth, welcome. How are you doing?
Yeah, good. Thanks, Jedi. Appreciate having me on.
Yeah, it's great to have you. Firstly, got to say this: you guys definitely have the best website in DeFi. Love it. I love this 70s Fallout vibe. To all of you who haven't played Fallout, go and check out the Bumper website and you'll get the feeling. Awesome. Well done, man. It's such a cool site.
Great, thanks.
Just an intro in terms of what you're doing and where you're from, and let us know.
Yeah. Well, I mean, essentially Bumper's journey kicked off probably about 3 years ago now, 3 years ago. And that really stemmed out of my co-founder, Jonathan, and myself really kind of looking at the explosion, or at least the start of the explosion in DeFi, and saying, well, actually, this is where there seems to be a lot of really interesting stuff going on. But where is it that there is a kind of fundamental issue that we could possibly develop something to address? And really where we landed, and this took a while of quite a bit of exploration to really get to the point where we looked at what started off as a kind of looking at CDPs, the kind of requirement to over collateralize when you're kind of borrowing or whatever. So we started kind of working on a concept around that, and that just through a lot of scoping, and we got in a company to help us where we scoped out the project. And what really stemmed was that what came out of that was Bumper, which was probably a lot more grand vision than we originally started out with. And essentially it looks at risk of price volatility, essentially. So when prices are going down, we all know this in crypto, just the level of volatility that we just live with on a day-to-day basis. It's kind of like living in a war zone, but we don't quite realize it. It is actually really quite volatile. And so we have created a protocol that will allow you to protect the price of your asset. And what I mean by that is essentially if you had, like, for example, $1,000 of ETH and you said, okay, I want to protect 95% of that, you'll set a floor at $950 worth. And if the price of ETH goes down so much, so let's say the $800 worth of ETH, and you're in a position to make a claim and exit your position, you'll walk out with $950 worth. And so effectively you pay for that privilege, you pay premiums to do that. And those premiums seed the yields for the other side of the protocol, where people are supplying liquidity providers, what we call makers, are providing liquidity in stablecoin to support those positions. And that's kind of basically how Bumper, what it does, how it works. That turned out way more complicated than we ever imagined. And we're looking to launch at the end of this month. So it's been quite a long journey, but hopefully it'll be really worth it.
Yeah, you've given me way too much to think about here in terms of so you jump straight into it. Okay, so you're saying that effectively you're protecting the price of whatever it is, in this case ETH, through a process. Is it a process where you stake the ETH and you basically relinquish it to a contract? How does that process work in terms of, essentially this is a risk management protection process, is that correct? You're protecting the value of your asset, in this case ETH. Explain that process or the dynamics of that process and how it works, like I'm 5 years old, please. Yeah.
So essentially, the easiest way to look at it, the protocol, is to kind of look at it as two sides. There's a taker and maker side, and the taker side is made up of an unstable asset like ETH, right? And the maker side is made up of a stable asset. So a taker who is looking to protect the value of that ETH will send that ETH to the protocol. So it's all done in smart contracts. It's non-custodial, permissionless, all that. So proper DeFi. And they will send that ETH to the protocol and take out essentially a policy. So there'll be some basic choices that you make that will make up that policy. And that will be things like the amount that you actually want to protect, the floor price, and the term, how long you actually want to protect it for. And that can be anything from 30 days to 180 days. Now, if you then think of it, now you will be paying a premium, dynamic premium. I'll get into that a little bit later, but essentially you're paying to protect, and those premiums go over to the other side where there are makers who have provided USDC. In this case, we're starting off with USDC into a pool, and that becomes, I guess, the pot that will support any loss in that price. Now, what incentive? It's really very much an incentive-based kind of protocol. So each user, depending on where you are, is incentivized to utilize the protocol. So a taker is incentivized because they don't want to lose their ETH, the value of their ETH, so they want to use it, and they'll pay for that privilege. And the makers who are there, putting up the stable coin to support that, are incentivized because they're earning those premiums. Essentially, they're getting paid those premiums as yields. And so what I like to think of that is a kind of true yield, a natural flow of yield. It's not like these kind of yield farming things that we see in DeFi, where you're just kind of getting the native token that you can flip and eventually it crashes at some point. This is very much someone is paying for a service, but you're actually getting that money. And because you're providing that service. So by pooling lots of makers and lots of takers, the protocol creates a balance between them. And it uses all these different parameters, these kind of measurements, to determine the health of the protocol, that it can support a potential claim. So it does lots of things to rebalance all the time. And by those kind of things could be, for example, a change in the premium price. So if volatility goes up, and maybe the protocol requires more makers to bring it a bit in better balance, the premium goes up. So then that encourages and incentivizes makers to put their USDC in, because they'll get paid more, and vice versa. So what we're fundamentally doing, when you've got this beautiful balance, this kind of elegant play between these pools, is what you're bringing to the table is efficiency. So you're saying, under these conditions, we can only, the protocol only needs to charge you this, and when it changes, it will charge you this. So it's not like an options, which is the classic way that's been going on for 50 years since they were kind of created. It's not like that in terms of what you're doing there. Is you're buying essentially a policy that you've already paid for, that you may not even take out in the end, and you are paying quite a premium on that. Whereas what Bumper does is charges you as you go and keeps it very efficient on price. So over time, you'll actually really get the best deal, and both sides will benefit. So that's the kind of beauty of it, as opposed to kind of the traditional ways. And things like stop losses, I mean, they're almost like a one-way train, you know, and we've all been in that position, haven't we, when we kind of take out, you know, we put a stop loss in, and then it just drops below that, you know, sells your position out, and then pumps double, and you're like, oh man. So with Bumper, you won't be subjected to that. So you'll still be in that asset because you're trying to protect it. You're fundamentally long on that asset, in this case ETH, which is what we're coming to market with.
Okay, so there's two things that come to mind here for me, and when you're talking about makers and takers, and obviously a fee, the thing that I'm thinking about, and I do apologize if I've got it all wrong here, but I think about, you know, running longs and shorts. You know, your shorts paying your longs paying your shorts. Is the dynamic similar in terms of how these pools work between the dynamic of your price and the price that you've set? Is it a similar dynamic, or is it very different from a risk management perspective? Or is that just a bad similarity that I'm drawing up in my mind?
Yeah, it's a tricky one to compare to kind of futures trading. Because first of all, when you're taking shorts or longs, you're essentially taking a position based on a potential future outcome. And again, you're going to pay a premium for that if that decision doesn't go your way. In Bumper's case, if you think of it as almost a social contract between buyers of risk and sellers of risk, that allows you to pool the conditions into separate states, and to then through kind of algorithmic determination, and that's complex what we've done, it defines what that optimum price point will be. So it actually fundamentally takes out the risk of that decision to a much greater degree than doing kind of short long strategy, or even in options where we're a bit similar, where you've taken out a policy and it is now paid for, and you may not even call on that. You know, you may not actually execute that in the end. So where you're in a position is that you've not made such an upfront decision, and the more upfront your decision is, and the more the higher the cost will be, and therefore that increases your risk of losing. And I think the short-long strategy and options do that, whereas bumper, because you've put in your position, but the protocol is determining a more efficient price as you're going dynamically, you've actually reduced that kind of potential loss commitment. If that
part about what it is that you guys have done is that you've got like almost like a holistic perspective on what's going on between your takers and your makers. But with any market dynamic, with any kind of trading environment, there's got to be a winner and there's got to be a loser. How does that play out? Because you're just talking about winning here, right? It's like, this is like protecting you. It's a risk management strategy. It's almost like you're taking the risk out of it, but surely there's got to be someone who's winning and someone who's losing. Or how does that dynamic work? Does that dynamic exist here? What is actually going on here on a granular level between the makers and the takers?
Yeah, it's a good point. I mean, I'd always be wary about any kind of claim that it's a win-win for everyone, because that's everything in my years has taught me that's never the case. You always have winners and losers. But what this is, I think where this, without getting too kind of philosophical on this or anything, but winning and losing is also about time, right? So when you, in a case like bumper, right, or anything, you know, that may kind of I guess in life could be similar to this concept, is that when you're it's at what point do you make that decision that it's now become a loss situation or a win situation? And I don't think we can underestimate what that is. So like that example of the stop loss, right? That decision was made earlier. And so when something happened that the price went below, what you've done is you've made an earlier decision, and the culmination of that decision has turned out to be a loss because the price only momentarily dropped below and then went back up. If you had chosen to put the stop loss even lower, it may not have triggered, and therefore that would have been a winning decision. But when you make that decision much earlier on, it will be a harder time for you to make that a win. What bumper does is that decision is fundamentally a regular decision and is priced accordingly. So you're extending, or bringing your decision-making time closer to the point at which it needs to be made. On a macro level, as a user, that will be based on your policy. So you could look at a 30-day policy, and at the end you've actually benefited, and your assets are valued at or above what they were. So it's done its job. You've paid your fees. You're still up potentially. But what happens is what decision are you going to make at that point? Are you going to renew or not? Will it suffer more volatility in the next 30 days? That's unknown. And so the decision you make using another strategy like stop loss and option has to be made at that point and paid for at that point under those conditions. With bumper, you pay for it as you're going incrementally, and therefore you distribute that kind of risk of early decision making over time. So this kind of win-win-win-lose situation is really a discussion about also over time. And that's the same for your makers who are providing liquidity. They are where the takers and makers are fundamentally aligned is that they are aligned on their opinion of that asset. They actually believe long-term in ETH, for example. They're long on ETH. They just have different short and medium-term viewpoints on ETH. And so a maker may believe that the short term, it's actually good for ETH, whereas the taker doesn't believe that, hence why they're taking their positions accordingly. But fundamentally, the taker wants to retain their ETH because they are long ETH, and the makers are prepared to put up their stable coin to protect your ETH because they are also long-term believing in ETH. So there is, and I wouldn't say that outright, but likelihood that over time, over more time, you're more likely to win more often than not. So I think that you always got to put that time concept into that kind of discussion.
So in terms of the time periods that you guys are planning to have or have put in place, are there like set times like 7 days, 14 days, 30 days, 60 days? How does that dynamic work? Or do you predetermine as Bumper what those timeframes are, or can the user determine what those timeframes are?
Yeah, so this was a bit of a thing in design, a few of these types of questions. And it's kind of like not only how long, what are the terms going to be? Can we protect for extremely short periods of time? Can we protect for extremely high floor levels? Can you protect 100% of the value? Well, yes, in theory you can, but it's also about what we had to determine, and these things may evolve over time, but what we had to determine is what is reasonable, what will the market feel is reasonable, because you can protect that 100%, you can protect it for 3 days, but it means that it will come at a greater cost, and will the market bear that cost? So what we did was we set kind of parameters. 95%, for example, is the highest floor level. Again, back to my example before, $1,000 of ETH, so you can protect up to $950 of it. The other aspect is the term length. So we sit in 30-day terms, 30, 60, 90, right up to, I believe, 180 days. But again, they will also constitute how the premiums will be determined. So naturally, the longer period of time that you put in, then the more likelihood that it won't cost you as much. Protocol fees, which there is a bumper protocol fee, will be less over that period of time. So there are some benefits in those kinds of things. So a lot of calculations go into it, but essentially 30-day terms right up to kind of 180, starting at 30, and floor level up to 95%.
Okay, so I just did a quick search on one of my screens here as to what the all-time high of Ethereum was, and it was at $4,000, for argument's sake, $4,900. So if I was in a situation where I bought the top, like a lot of people did, and I wanted to protect myself against obviously a downside to that, and I had put in essentially what do you call it? A bumper strategy? What would be the terminology?
So you would essentially bumper your asset, right? So
yes,
you take your ETH and you just send it to the bumper protocol. You get back what's called a bumpered ETH,
yes,
and that will be allocated as a kind of token. And then fundamentally, you've now got your position. You'll get what you get back is an NFT that essentially gives all the policy details, and that make up all those things that I just said: floor price, term, the amount of ETH, that kind of stuff, what the kind of USDC value was at the point in the policy. So that's what you get back. When you get to the end of your term, let's say it's a 30-day term, then you've got essentially a choice. It's kind of 3 choice: close, claim, or renew. So a close position means that you are actually, the price of ETH is above, and your price of your protected assets is above what you have protected it. And a claim is if it has actually gone below, and that's where you will then get that amount, that $950 in that example before. You'll get that back in USDC. Then you're now in a position where you could also renew, and that's renewing, for however many, days you want to do, the 30, 60, 90 days as well. So those are kind of 3 options as a taker for the protected. And then you, as an earner, someone who is a maker providing liquidity, stablecoin liquidity, you'll have options there as well. Same kind of things. The difference between there, whereas with takers, you're choosing a floor price. As a maker, you're choosing a risk level. So in theory, if all else being equal, a higher risk level that you want to choose essentially means that you will earn higher yields. Lower risk level, lower yields, but then there'll be less of an issue for you if you're in a kind of lower yield, lower risk category.
Okay, so that's a great explanation, but you've thrown the cat amongst the pigeons here, and you've brought up yield. So we need to kind of go back a little bit now and just look at how that dynamic works within my commitment. So I'm obviously handing over my Ethereum in this case, because we use Ethereum as an example, essentially as a basis for my understanding as collateral, which is then used to obviously put me in line for essentially the bet that I've placed around potential volatility. But is that collateral now used as a basis for yield generation from that point onwards? So essentially, do we have a two-way process here? Explain to me how the yield dynamic works within the current structure of, this very eloquent dynamic that you guys have created.
Yeah. So if you think of the flow of money within the protocol, is that ETH goes into one side of the protocol, and premiums are incurred on a dynamic basis. They are paid in ETH. That then goes to those makers. They earn that pure yield. That is their core yield generation. They put in their stable coin, but they're earning those premiums. As a taker, you will also pay a protocol fee, which is more a fixed rate fee based on how much you put in, the TVL of whatever you put in, and that goes to the bumper to help keep growing the protocol. So those premiums will be paid to the makers. It's almost like a kind of mutual insurance kind of concept, if you're kind of familiar with that kind of idea. So the makers are earning those yields, those natural kind of true yields, I like to call it, as opposed to kind of funny farm flipping and whatnot. The intention, it won't be for V1, but for later will be that there'll be a portion of either pool that we will farm out to kind of other protocols that are generating yields on those stable coins, for example, earn those yields and bring it back to help to also earn for the makers. So there'll be a kind of second level of earning capability at some point. but at the moment it's the core, which is the premiums.
Nice.
And this is that kind of social contract that I'm talking about, because you're essentially creating this kind of pooled scenario of a pooled group of people that are paying money and another pool that are earning those, but they're buying that risk. Essentially, they're providing the support there. So the protocol constantly rebalances to make sure that it's healthy. And what the protocol is really trying to look at are three major things that it's trying to balance, right? It's trying to balance the premium price and the yields, to say, because if we go too high on premium, then that discourages people to use the takers, but it encourages too many makers, and then that's distributed to too many makers. So then they will leave because the yields aren't as high. So there's this constant kind of balance playing, but at the same time, what you want the entire time is solvency of the protocol. So what we did was we've run backtesting for 2 to 4 years. So we've covered some of the most brutal times in crypto history, in ETH, studying ETH. And with our simulations, we've maintained solvency every single time, even over 4 years. And we're still generating premium that is 10% cheaper than options. And when I say options, I'm talking about compared to Deribit, which is the largest centralized options for crypto at the moment. And anecdotally, we believe that we're probably twice or half the price. The decentralized options that are out there at the moment are probably double what Deribit is in terms of cost. So we're already proving that we can run premiums cheaper, 10% cheaper than standard centralized Deribit options, let alone any decentralized option out there. So at the moment, we're probably going to be kind of top of the decentralized market and better than the kind of market leader. But from that, even though that's cheaper, we can still generate between 5 and 25% yields for those makers. So we think there's a good balance. And as I said, that kind of trilemma, we maintain solvency the whole time.
Yeah, I think there really is. I mean, I was just thinking when you were telling me about the fees, I was like, oh, this sounds like it's going to be quite expensive. You know, like, sure, I'm going to be protecting the value of my asset, but I'm definitely going to land up paying a premium on it. But it sounds like you've also thought about essentially the most cost-effective solution. So yeah, well done for that. Because I mean, I think we've seen, like, within the DeFi context, you know, degens kind of, I mean, and I don't think for a second that this is by any means a degen project. I mean, product itself, but it's like maybe the project are a bunch of degens, but I think the product itself isn't. I mean, it sounds like it's quite a sophisticated and well thought out process. But the degens are going to land up using it because at the end of the day, even though in the middle of the bull we're quite happy, well, not quite happy, but we're forced to pay $200 to $300 gas fees. Yep, I was there, I saw it. You know, I still think there is a mindful approach to, you know, what people are paying around a protocol. I mean, it's really weird, you know, it's like we complain about, you know, going and paying for parking. I mean, like, paying for parking here is like a big thing where we argue all the time. Like, I went to a shopping center and they're actually billing me for the parking. But it's a nominal fee, but we do still complain about it, and it does determine whether we're going to use a protocol or the parking in this case, you know. So I think that's really important, and I think over time it's also important as well, because it, you know, especially if you've got big numbers going and you're paying a percentage, you know, 50, 100 grand, you know, seven figures or whatever the case is, because there are whales out there that will use the protocol for that protection. In terms of the dynamic, just coming back to the dynamic between, just to veer off a little bit more to the left here, is that do you limit the amount of makers and takers within the pool and the dynamic between the two, or is that open-ended in terms of and how the balancing works? Does the balancing then work? So if you've got 50 makers and 10 takers, because they're obviously viewing the market in a different way, is there like the rebalancing? Does it land up becoming skewed to the one direction in terms of the fees? How does that dynamic work?
Yeah, so it's a good question. It's a tricky one to answer in that there are so many different parameters that are part of the calculations to determine those fees and yields and subsequent yields, that really, if you try to distill it down to a very basic concept like that, I'd be saying, well, it's less about how many makers and takers, it's about also the TVL, right? So it could still be the same amount, or the right ratios, but there's just less of one than the other. But that would be taken into consideration. So, but effectively, that is how it works, what you alluded to in that, where there is an oversaturation on one side, then there will be a change in the premium, which if you see the premiums as yields as well, it's just a different side. It's premium to one person, a yield to the other. Then that effectively will change to help the rebalance process come back to the ratio that we set the bumper protocol to work at its most optimum efficiency. And that's all based on a lot of that that simulation, that learning that we've had, to say, okay, this is where the protocol is at its most optimal position, and that's what we're going to try to achieve, that rebalancing. So these are all the kind of tools that we use. There are a few other tools and stuff, but those are kind of, I guess, first order kind of mechanisms that allow you to rebalance pretty effectively. And we know the crypto market is fundamentally a highly incentivized marketplace, generally speaking. So we can drive those sides quite well by incentivizing it in the capacity, by changing premiums, and fundamentally that changes the yields. And although sometimes we think about premiums going up, and that means the yields go up and encourages more makers in to support, but at the same time, an oversaturation of makers is not necessarily healthy, because then you have lower yields that distributed among, and therefore that will naturally lower. There'll be kind of lower premiums as a result of that, which will eventually disincentivize makers, and so some will leave, and then it will rebalance. So it's a very easy, simple way to look at it in that sense. But there are actually, I think, last I spoke to our CTO, was probably around about the 95 odd parameters or something that go into these calculations.
So there's two things that have come to mind, and just when I was doing my research on Bumper over the last couple of weeks, is that you talk about permissionless. There is immutability, right? Or is that part of? So immutability is part of the whole thing. How do you change the parameters? Are the parameters sitting on top of the contracts in terms of how you make those adjustments? How does that dynamic work? So I know I'm getting into the weeds now.
Yeah, it is. No, they are changeable. So it is a matter of just changing them. But obviously our intention is to try to get that right. And over time, as there's more and more real world, and in time, we'd like to start adding like AI layers in to help us better optimize those kind of parameters. they can be reset to different levels to better optimization. And that's where we run simulations all the time to better optimize it. But at the moment, what we've found is that the settings that we will go to market with, we've run simulations and we're getting those kind of results that I showed. And actually, we are slightly getting they're changing at the moment because we're optimizing a little bit more and results are looking promising. But we are looking at that kind of like 10% cheaper than options and 5 to 25% kind of yields for makers. But we're solvent for up to 4 years. So going through, I mean, what I think has probably been the most volatile time in crypto history in the last 2 to 4 years. We've held up pretty well. So, really well. So yeah, I think, and what that says is that basically with those settings, we can do this over the last 4 years through these really awful conditions, which is really, really promising. So really it's up from there, isn't it? Just to optimize it, get it better and keep kind of improving that. And then obviously we're going to do other things, do kind of layer 2 and some optimizations that will help with gas costs and all those kind of things as well, and whatnot. And also, fundamentally, we're also trying to look at where we can take that bumpered asset, that bumpered ETH, how that can now be used in other protocols. Because ideally where we see a great opportunity for the bumpered asset is to be able to basically take that asset, whack that into a lending protocol, an Aave or something like that. And now you've got you've almost like stabilized that unstable asset, which should theoretically allow you to take out lower collateral loans because it is fundamentally backed by the bumper protocol and all those makers that are supporting it.
Great. I think
that's for V2 and whatnot.
So, I mean, I know that with any protocol, there's obviously the desire to attract the business, whether it's, from a business development perspective and speaking to other protocols like Aave, for example, and the rest of it. There's also the most important aspect of the momentum, and that is obviously attracting users to the protocol. I mean, everything sounds amazing. I mean, it sounds like you guys have really thought about this thing in a very careful and in a very eloquent way. But at the end of the day, it's all about incentivizing. Like you said, DeFi is very much centered around that. How are you guys looking at incentivizing on launch? So we're looking at a launch at the moment towards the end of August. I assume that's on track. How can people get involved now and going into that launch, or is it something after the launch that they'll be incentivizing? What do those incentives look like?
Yeah, I mean, we'll be announcing more stuff as we go. Some things that I can say, which have just been announced, is that there will be a SEX listing. We'll listing on Bitmart on August 17th. We are on track for the end of the month to launch. So that's positive news after so long in development. We're really looking forward to it, and to just move on and keep developing, version 1.1, 1.2, and version 2 and whatnot. In terms of incentives, there is quite a strong, which I probably haven't touched on, strong incentive for users to start looking at the bump token and potentially acquiring that. Is that a part of the protocol is when takers and makers take out policies, you bond bump tokens to the protocol. And this is an important part that we've done by design. So something I always try to really make very clear to people is that you need the bump token. It's like the grease for the protocol, and to help drive that network effect. So there is an inherent incentive for users, people to want the bump token. And that's important because you need that bump token as part of what we say is a bond. So you bond the tokens to the protocol when you take out the policy. When that ends, you get that back. So it's a temporary bond, but you will require it to actually utilize the protocol to interact with it. There are some incentives in terms of the that will start to occur with the DAO, in terms of the DAO staking. We have some incentives at the moment to be a liquidity miner. So we have a couple of Uniswap pools, but the main one here we're talking about is V2, which is a bump USDC pool. So if you're a liquidity provider there, there are incentives to that you can get bump tokens for liquidity mining. And then not for V1, but later there will be a staking module. And what that staking module will do is it kind of will act as an ultimate backstop for the protocol. A bit like Aave's safety module, where it kind of acts as a backstop primarily for hacks. Ours will be used in a different context, but you'll be able to stake your tokens, but you'll earn rewards from that. And that is essentially, fundamentally putting your tokens or some of those tokens at risk in the same way that Aave does with their safety module, but it will support the protocol, and you'll be incentivized accordingly. So there's some mechanisms there. There will be some incentives through the listing, the SEX listing. So anyone looking to earn that way, then do keep an eye out for that as well. And there are some marketing things happening that our marketing boffins will be announcing as we go, some opportunities to earn bump in various different ways.
I think I need to get my hands on that document before anybody else does. Is that possible?
I can't. I've got to beg from my chief marketing
looks
officer.
I'm gonna have to beg for it as well.
Exactly.
I have to ask this question. What do you see as the biggest challenges for Bumper as a product? Like obviously you guys have run your simulations around the data, and it's almost like it's a separate thing, like, okay, cool, we understand the market, we understand what drives that, but what are the challenges that you see, like when you think about this thing, like where the hell can things go wrong around this thing, besides contract risk and all that kind of stuff? Just looking at the market right now, what do you think the biggest challenges are for you guys?
Yeah, you're right. We like a lot of protocols, we do kind of a lot of smart contract audits and stuff, and you do as much as you can with that kind of thing. That's all really important. We run simulations and for economic security and that kind of thing. I think like any early stage protocol or project, scaling is always probably the most challenging thing. So we want to scale that we have enough takers who are interested in protecting, and enough makers that are interested in earning those yields, that they're comparable by market standards, which we think they will be. And so there are those kind of scaling things that you want to get to scale and that helps the protocol and helps all the token holders. Naturally, strong price of token is always important, especially when it is, helping support the network, not just through governance, but like I said, with the bonding and all that kind of thing. Those kind of things are really important with, also if it's good price of the token, then things like staking and all that, those incentives become much easier to kind of execute and sell to users. So those are I see those as very standard kind of problems that most projects have. The kind of more unique issues we have found is that it's very complicated. Our protocol was a tough nut to crack, how to do this, create an efficient marketplace for risk, and basically try to come up with something that's better and more efficient than what's been going on for 50 years with options and stuff like that. So where we think is that once we open up the source code, that hopefully we're going to have lots of really good talent coders looking at it, looking to optimize and make it better and improve. We've already released the DAO, so that is something that the first proposal will have to come soon after launch, and that will also come from the public, where they will be able to improve. Because what we have found is that it's really hard finding top level Solidity engineers. They are not a dime a dozen at all, and I would not be surprised if there were only 50 Solidity engineers in the world that could do something like this, that could build this, let alone even understand it. We've got a great team, we've got great guys, but it has taken a while. We've sifted through quite a few that didn't make the cut and couldn't get there. And so I think that's more probably the unique side of it, that it's quite challenging, it's interesting. So hopefully that will appeal to the Uber geeks out there that might have the talent to kind of get stuck in.
Yeah.
So I think that's probably our biggest thing.
If I may add to that, I think one of the interesting case studies that I've observed, almost as a comparative, is that you have options, right? And we've seen how, we've done quite a lot of work with options and understanding options, and primarily educating what options are about within kind of like the crypto space, and particularly DeFi, because that's what we've always focused on. And I think like a really big challenge, because there's some really great options protocols out there. And the reason why I'm drawing a parallel between what Bump is doing and what options trading is because it's just simply something different, right? And it is fairly complicated. Options are not the easiest things to understand, and I don't think that initially Bumper will be easy to understand. We hopefully will go out there and try and educate people, and because we just find this kind of stuff fascinating, and it's kind of like our responsibility to do that anyways as blockmates. But I still think the big challenge for you guys is going to be the educational aspect of it, and how do you get the incentives that are set up across the line with that education. I think those are the two, and it's obviously something that you're aware of. You're doing that. I've seen the content that you guys have put out there. It's all about that because you understand. But I think that's going to be, not because the product isn't good, not because that's the biggest challenge in my eyes. Obviously all the others that you've stated, but in terms of someone looking from the outside in, that's going to be your biggest barrier to entry, just purely because DeFi protocols have struggled to get the options one across the line, and they still endeavor. I mean, it's just, Dopex, they are relentless out there. I mean, they are probably one of the most consistent content creation. I mean, they've become a content creator, with their protocol. It's bizarre.
Yeah.
It's because they see the potential. Yeah, that's what it is.
It's a tough one. Yeah, you're absolutely right. It's like when you're bringing something completely new and innovative to the market, there is this process of education of what this is, and you get a few different users. There'll be kind of power users that use options all the time, and they'll think in those terms.
Yes.
And they'll feel very comfortable with how options work and what they know about that. And they might feel a bit, unsure of this. But I think where we, I guess, have the chops on that is that we are kind of proving we're quite efficient on price. So someone said to me a while back that traders are very quick and clever to find optimal pricing, and so if it's kind of like a field of dreams thing, right? If you build it, that will come. If you get that right, then they will find their way there, and the degen communities do kind of interact quite quickly on this stuff and find those alphas. Now, the other types of users are those that don't really understand options, may not have even heard of it, like the idea of protecting, but kind of need to know, how does this work? Where are the pitfalls and whatnot? And they're probably the trickiest ones to kind of teach. And but we are busting out a lot of content as well. And obviously you guys going to help with all that. And hopefully that kind of messaging gets out. What we've tried to do as well is make the user experience extremely simple. We've spent a lot of time thinking about what that looks like, and the way we kind of structured the DApp was a kind of 3-user structure. So if you were for lack of a better word, you just want a simplified, more simplified user, you don't really want too much detail, then you can actually execute on a policy very quickly with very basic detail and everything you need to know, but very quickly. So a matter of a few clicks and you're done. And it shows very clearly that you're protected. If you're a little bit more, then you can dig in and get a lot more information on what that policy, what that kind of entails, and where your positions are, and whatnot. And then if you're at even more, then there are more metrics and stuff and documentation that we'll have in Gitbook that where you can read and better understand all those kind of things. So we think we're gearing up. We've set ourselves in a good position from that perspective for those kind of users, and we also have a regular content program coming out to explain better. And then you've got your kind of third users who really just want to know the outcome. They're not interested in the means, they just want to know the ends. So if I put in this ETH, will it be worth this much at the end of this time? Yes, it will be. So you don't need to kind of concern yourself about the ins and outs of it. And so, and in some respects, they're kind of easier, but probably a later stage user that may not come in immediately anyway. So we're putting ourselves in a good position, but there is definitely an education thing that we need to go through. And we do have to find that niche because we're not options. We work differently to options, but we do protect price fundamentally. And but we do it in a different way that it's maybe not as common. But it does seem, that, DeFi is just constantly changing. It's always just new things coming out all the time. And we think, we're bringing out a product that is absolutely going to be at the kind of future of the financial market, and where options, which is I understood was a $13 trillion market in traditional finance, and it doesn't seem to be as big in crypto and DeFi in particular, but it is one that's about to happen. And not just when the institutionals kind of come in to the marketplace more than they have, but when certain things like that align and they start seeing that kind of price efficiency and that kind of thing, that will incentivize bigger players. Because if you're talking hundreds of millions of dollars that you're looking to protect as institutions, that's 10% cheaper than what you can get elsewhere. That is a lot of money that you can be saving, and that makes a real difference. So I think we're the start of something very positive for kind of those bigger players as well.
I completely agree. I think the innovation needs to carry on, and that's what you guys are doing, and it's encouraging to see that there is a product like this. I'm definitely going to be checking it out and getting involved. It seems like a no-brainer to me. And I think that, we are definitely going to look at, like I said at the beginning of the stream, I think you guys have built one of the most, it's my favorite website in DeFi at the moment. And I don't make that comment. I don't say that easily. And what I like about it is that it's very easy to understand. You've got, and I think from our perspective, we're going to do a rundown on this website, but it's all very intuitive, from the governance side of it to the liquidity mining, and it's going to be really interesting to see how, that interaction takes place from a user experience going forward. So yeah, great job on the website. I think it's
thanks
cool.
for that.
Yeah,
we've spent like I said, we've spent so much time on that kind of thing. It's something that I think the crypto market is sorely missing. They're just cookie cutter websites out there. We wanted to do something different. A lot of us come from creative backgrounds as well, so we do tend to value the importance of kind of visuals and aesthetics and branding that is something different and speaks. And we're all kind of 80s kids, so it was nice. And there is a nice parallel with the 80s in that a lot of these really innovative financial instruments came out then. It was a booming market. It's when the stock market really shifted and became kind of where it started and became what it is today. And so DeFi is kind of in that stage at the moment. I think, we've kind of had those few stages in DeFi where the very basic kind of, things like MakerDAO and Uniswap, early stage kind of, using pooling and whatnot, DeFi kind of 1.0. Then you have your DeFi 2.0, which, your more interesting kind of instruments, synthetics, all that kind of stuff, and the interoperability between different kind of pools and protocols and whatnot. But we're about to enter a third phase of that, where we can now fundamentally do a lot of what traditional finance can do. We're just not as efficient at it. And scaling is a prime issue. So the next phase is all about scaling and efficiency, because fundamentally those big players, those institutions that we all kind of keep talking about when they're going to come in, well, they'll come in when the product is better.
Yeah.
And that means it needs to be better at scalability, and it needs to be way more efficient in all different facets. Because when you're talking about what they can do with a high frequency trading and depth of markets that they have, we can't quite compete there, but we will get there. And so we've certainly tried to use that at the forefront of what we're trying to develop, and thinking about those scaling kind of issues, and also efficiencies, and trying to make it literally the most price efficient thing out there.
Okay, sounds good. We're at the top of the hour. We like to keep it just within the hour. It's been really interesting and somewhat mind-blowing to chat to you, Gareth. Thank you so much. Yeah, it's been really cool. Really enjoyed it.
Thanks,
I really like what you guys have built. It makes sense. It's a no-brainer. You know, it's like it's something that's needed, and it's going to be really interesting to see how, you know, it does out there in the wilderness. So we'll definitely get you back on. You know, good luck with your launch on the 30th. And then also your central exchange listing. I think that's quite a big one for you guys. I hope it goes well. And I'll put all the links in. I'll just get the links at the bottom of this broadcast. We'll put in all the links in terms of your socials, Bumper, everything. We've obviously done an initial article as an introduction to what Bumper's doing. And we will be following it up with essentially a how-to guide. So just in terms of our listeners and our community, just look out for that. Go read the Bump article. It's really interesting what they've done. Obviously, the interview puts it into context. Please like and subscribe. It means a lot more than you think it does. Take the 2 seconds and do it. Gareth, appreciate your time, sir.
Thanks, really Jedi. Cool. Appreciate it.
Yeah, man, it's been really cool.
Yeah, thanks for that.
And
enjoyed that.
Hope to see you soon.